What is happening, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show and my segment called Next Level CRE, bringing you your mindset, your business, your ideas, your inspirations, all the stuff that we can bring you to the next level. And thank you for joining me today. Before we get into today's interview, I want to just remind you guys to go to bestevercre.com. Check out our newly revamped, newly upgraded, brand spanking new website where you guys can check out all kinds of things like the fast tracks we have to offer. You can consider Best Ever's talent solutions to help you find new pieces of your team. We can do all kinds of things for you at the Best Ever website. Go to bestevercre.com. You'll learn all the kinds of different things that Best Ever can do for you as a rising, amazing GP or LP in your business. I will see you guys there at bestevercre.com. Guys, we're going to jump in today to today's interview into a topic that I don't talk much about. I really got a lot out of today's interview I got into the mindset of just those that are taking advantage of the truth that America is becoming more of a renter nation. It is. It's a fact. The idea of having the home and making that the American dream and all those things. Perhaps that's changing a bit to a point where there's an investment strategy that takes advantage of what people want out of owning a home. And they don't have to actually write a big ass check to buy the home, or they don't have to maintain the home. They can just live themselves in a BTR communities. We're going to talk a little bit about BTR and about the other communities that live in BTRs. Maybe not people that want to raise families in BTRs, but there's other bookends of the BTR world for people that want to live in BTRs that are maybe not, young upstarts looking to raise a family. Let's bring in our guest today, Josh Hartmann from NEXmetro, that's going to tell us all about his angles of BTR and unpack a lot of really cool ideas for us in that space. Let's let him in. Best ever listeners, I am excited for today's interview because we're going to get into talking about something that I am super curious about, but I don't know much about. And that's where I get dangerous, but also really curious and have a lot of fun. And that's where we get a good conversation going. So today we're going to be talking to Josh Hartmann from NEXmetro, who's going to be talking to us about BTR. Josh, welcome to the Best Ever CRE show.
Hey, Matt. Thanks for having me. Look forward to the discussion.
Yeah, man. BTR, right? That's why they call it BTR, but like not for nothing, everything's BTR. We're building everything. If I'm building it to do something, I better be building it to sell it, live in it, or rent it out. One of the three, right?
Yeah, absolutely.
Another,
it's like the worst name ever. Whoever came up with BTR, it's not a good name. It is what it is.
But somehow or another, we all know what it is, right? So how did you get into the BTR world? Maybe we'll hook up the best ever listeners. What is BTR? We'll go 101.
Yeah, real quick, because you're 100% right. We're all building stuff to rent. So why is it called built to rent? So built to rent is essentially there's three categories of built to rent. There are single family homes that are on single homes on single lots, right? Just like you would think of, but you're renting them instead of selling them. Then there's townhomes. That's kind of the second category. The largest category of built to rent is townhomes. And then there's this third category, which is what we fit into, which I like to call cottage style BTR or cottage style multifamily, where we're building, 150 to 300 homes on a single lot, right? So it's kind of like garden style multi, except we're building little homes instead of building these big, 150 unit buildings. And so those are the three categories. The reason it got called built to rent, I think, is because people were trying to think about, well, how do I differentiate it from garden style apartments and, traditional kind of high-rise multifamily, et cetera.
Yeah.
It was kind of thought of as really single family rental, but we're building it. So let's call it built to rent instead of, so that's how it came about. Doesn't make a lot of sense, but it is what it is.
It is what it is now.
It is.
Help me with the three that you just taught. So you like a tip at number one, the three different ways to do it is a typical housing development, right? Where like you build a house and it's got a yard all the way around it. And it's a single standing structure with a single family people, a group of people. Is a single family home, right? Townhome, I guess that, it totally makes sense. like a string of homes. What's the third one that you said that you guys focus on? Help me understand that one again.
Yeah. So ours, our brand is Avilla Homes. So all of our communities are called Avilla something, and they're all exactly the same. And we're building 150 to 300 homes in a call it 20-acre property, right? And they're all single story, they're all detached, but they're smaller than traditional homes. So our average home is 950 square feet, whereas a traditional home, something that a big REIT would have is probably 1,800 to 2,000 square feet. So we're building these smaller homes. They don't have attached garages. They have separate garages like a garden style multifamily. We always refer to it as a hybrid product.
Hmm.
It's somewhere between multifamily and single family. And we do a 1 bedroom, 1 bath that's 650 square feet, a 2 bedroom, 2 bath that's about 1,000 square feet, and a 3 bedroom, 2 bath that's about 1,250 square feet to 1,300 square feet, depending on the market. That's all we build everywhere, and they're all on a single lot, right? So I could not sell one of our villa homes,
Yeah.
to an individual because I don't have a lot that home sits on to sell them to. So we're selling our assets to pension funds, REITs, et cetera, like multifamily. So from a financial standpoint, we are multifamily.
Yeah.
All of our partners would say we're multifamily. We do multifamily loans through the Fannie and Freddie. It's just we build these little homes, and that's what makes it different than the other categories of BTR.
But it's not like, the tiny home thing you hear people talking about, which is straight up, like a little teeny tiny home. These are smaller homes. And are they single story, or are they, you said it's the same thing, same thing over and over again. So you're building a single story.
All single story.
Okay.
Single story, 10-foot ceilings, lots of windows. So you've got, I like to call it 4 walls of freedom, right? You've got your own little home, your cottage.
Yeah.
You got your own little backyard where you can let your pets out to. But we maintain everything like a garden style multi, right? So your light bulb goes out, we fix it. Your garbage bills goes out, we fix it. We have on-site maintenance, on-site property management. We've got a leasing office, we've got a pool, we've got a dog park. So we're kind of like multifamily in terms of amenity, but the biggest amenity is you're living in this smaller home. And if you walked into one, you would say, how big is this thing? Like, that's the biggest. And we're like, well, it's about 1,000 square feet. It's like, man, it feels so big.
Right.
Because we do 10-foot ceilings, right? Because it's kind of feels very spacious, and you got your laundry room and all that kind of stuff. So it's a little bit different, and we're hitting a different customer. So if you think about the single family rental groups, their typical customer is going to be a couple with kids, right? They don't want to live in an apartment. They don't want to buy a home, or maybe they can't buy a home. That's their demographic. Our demographic is 25 to 35-year-olds, professionals, great incomes, aren't ready to buy a house yet. That's kind of one demographic. And then the other demographic we attract is retirees or empty nesters that don't want to maintain a home anymore, but don't want to live in an apartment.
Okay.
We provide them with the ability to live in a home that they're used to, fully maintenance free.
You're playing the ends of the spectrum, right?
Yeah, we're the barbell. Yeah, we got the barbell.
Yeah. So you're not doing, so not for nothing, you don't want those little crazy animals kids in your I got kids myself, so I can call them crazy animals. But your developments are not aimed towards families with kids, right? And I know you can't discriminate and everything like that, right? So you'll take kids, but you're not really aiming towards families with children.
Correct. Less than 15% of our homes have a school age child or below, so 18 or under in our homes. And I don't have kids, but
that's
I
why
would
you
imagine
don't build for kids. That's why. Yeah, right, exactly. There you go, right there. Yeah.
But I mean, if I did, I don't think I'd want 2 kids in a 1,000 square foot house, right? Like that would probably drive me crazy. Oh, yeah. So it's just our product isn't designed.
They're crazy little animals, kids, and they don't do well in confined spaces. They need to roam. They ought to really just live in the woods, honestly, kids. Right. So. Yeah,
that's what I did growing up.
Yeah, I did until the streetlights came on. Then I had to come home, right? But yeah, but okay, so that's an interesting tactic. So by doing that, you don't need to be. I met with another, BTR guy. I do see other people. I'm sorry. Met with another BTR guy at Best Ever.
I gotta go. Yeah, how could you do this to me? I thought we were exclusive.
Screw this guy, right? No, but. He's aiming to families, right? So he's doing the 3 and 4 bedroom new construction, multiple story thing. And he's got the fancy pants playground and the pool and the leasing, the pool that no one ever uses, how that goes, right? I see a lot of apartment complexes with a pool. Show me one apartment complex with a tenant swimming in a pool. It's like
for marketing purposes only.
Yeah, that's it. Right. Anyway, so you're not going to, and so those folks that I talk to, the school system that the development is in is paramount, right? Because there's an angle there that you want your young family to come in and think that, okay, I can rent, I can raise a family here, that whole thing, right? You don't care as much about that. That's interesting.
No, we don't. Yeah, we don't care as much. I mean, obviously, good school systems are, tell you that it's a good area that helps.
No,
but we don't have.
Yeah, there's indirect. There's indirect benefits of being in a good school system, of course. But
so in our investment committee memos, yes, we look at the school districts, but if they're low, that's not a deal killer, right? We're just kind of like, okay, it's noted. All right, we're probably not gonna, that's not our demographic anyways.
Yeah.
But it's good to know, right?
Yeah.
Because it does kind of influence
Sure.
how that community is viewed, et cetera, and how many people want to live there. But yeah, definitely not important to our residents.
Okay.
Now they're more interested in the fact that we have a dog park because over 65% of our residents have pets, right?
Yeah.
So we're catering to people with fur babies, not
Yeah.
people with
No,
actual babies.
pets are the children of people that don't have children, and it's
Right.
why
Yeah.
they're the children of the senior citizens and the young 28, 29-year-old something that doesn't want a kid yet, but they want a life and another life form in their house, right? So they'll get a pet. I love that. Yeah, because you're single story, are you guys using modular technology to build, or are you stick framing?
We're stick framing. I mean, we do a lot of prefab, but we're not doing any kind of modular yet. We look at it, and to be totally honest with you, we haven't seen anyone that's shown us that it's less expensive to build that way. And maybe it's because of where we build,
Yeah.
right? Because we build in, we're in Texas, Arizona,
Yeah.
Colorado, Florida, Georgia,
Okay.
right? All markets where you have a lot of, you can build all year round, obviously in Phoenix and most of those other markets.
True.
So we talk, we constantly are meeting with groups that are, hey, we've got this great modular idea, but it just there hasn't been a fit yet. And I'm a fiduciary to my investors, so even if an idea is cool, I don't really care. I want it to be less expensive so that my investors are having better returns, right?
I've interviewed a few modular folks on this show. I interviewed somebody they hadn't done it yet, but they were sure gonna do houses with sea containers, right? And it's sea container house program going on, at a modular guy on this thing, and they were just singing modular, man. I have yet to meet anyone in your space in the BTR world that is using modular. Everyone I've talked to is all stick framing. And I mean, hey, that must mean y'all know something. That's not like,
I mean,
it's like you haven't thought of it, right?
Yeah. The home builders would be, because the first thing they say to you the first thing a modular person will say to you is, let's not talk about cost. Let's talk about speed. Like, we can build these things so fast. And I'm like, I don't care. I can only lease them 30 a month, or 20 a month. Like, if I'm finishing them early now, I've got a drag on my construction loan because I've finished this unit, but I don't have anybody to move into it because I can't lease 100 homes in 1 month, right?
I see.
So if our building, the way we build our homes is like perfect. So I came from the home building world. We have perfect production home building, line home building, we used to call it.
Mm-hmm.
We start 7 homes a week once we go vertical, and we deliver those homes, 75 days later. And every week we're starting 7 more, and we're delivering them. So we're delivering our homes in about 25 to 30 homes at a time because they're all getting individual C of Os.
Yeah.
And we're leasing about 20 a month, right? So we're right behind deliveries with moving people in, and
so you
when
got
we get all the way
moving
around,
in, and I can look down the road and see the concrete guy pouring foundations, 3 blocks
100%.
down the street while he's getting ready to. Okay, so you're not again talked to another guy, and he was like, "Yeah, we pour all the pads for what he does." And then he comes back and does all the framing because according to his philosophy, that there is a economy of scale in getting the concrete guy to just go and knock them all out at once, right? But you're doing it from an absorption, like you're structuring out your construction. It sounds like that's a ginormous spreadsheet you got going on there to really nail everything down by the numbers and all. But you're trying to kind of almost have like a manufacturing, just-in-time manufacturing,
just-in-time delivery.
Yeah.
I mean, there are some things we do, right? So we do our, and I can get all the way into the weeds. I'm a
Go right ahead,
civil engineer, so like I love talking construction. That's my background.
Yeah.
But I mean, we do in some markets, we'll do all the pads at once. Great example of that is in Colorado, right? Because if it's the season, get the pads down. But
you don't want it to
in other markets, we don't.
You want to be pouring concrete in February in Colorado.
Exactly.
It doesn't sound like a good idea. Yeah. Okay, got it.
No.
Okay.
But once you get into framing, it's pretty much 7 a week, right?
Yeah.
Because what we found is for our subs, they love it because they know they can put 1 crew on the site or 2 crews on the site, and they know exactly what they're building for the next, call it 6 months, right? They're built next home. And so it's consistent revenue for them versus rolling in, blowing them all out. The other problem with blowing them all out is, what if you make a mistake, right? And now you got them all done and you got to redo them.
And you blew them all out, right? You got to go and undo it all out,
okay.
Right?
Oh shit, we forgot to put this is literally speaking for myself. We forgot to put the window in the master water closet.
Really?
And we've already framed everything out. Okay, go back and frame it, redo it.
Yeah.
I mean, so whereas if you're doing it one at a time,
that's a warranty thing, but you just lost 3 weeks,
Yeah.
And that GC or the framer is not cutting you a check for the time that you lost, right? They're
Yeah.
like, "Oh, I'll make it
Yeah.
right." Yeah, okay, make it
Yeah.
right, make me whole.
Yeah. Yeah.
Okay.
So it's definitely a good process to kind of have that, especially in new markets, right? So we're
Mhm.
looking at it every phase and we can make adjustments, but
Yeah,
everybody's got different opinions. Also, a lot of people do that if they're fee builders, right? Because they're getting paid based on home deliveries. We're not a fee builder. We're the owner operator investor, right?
I
So
see.
we're we're not as big of a rush to get all the homes delivered because we're not getting a fee on every home we see
It
about.
makes sense. So for like maybe 5 to 10 minutes, I contemplated the idea of getting into scale building. That's about all it took for me to think about it before I said, you know what, frick this, man, I'm not doing this. But I built 3 townhomes in Philly, and that's where the
Okay.
jug of Kool-Aid was sitting behind me, and I was like, maybe this is fun enough to do it more. And when I talked to my lender about it, he described the process you're talking about, where you kind of build them and absorb them as you go. And he was like, well, what we could do is give you a line of credit, and you would just kind of revolve through that line, and we were looking to build them for sale, so you would just build
Okay.
them out, build them out, build them out, and sell them. And as those homes are getting absorbed, then he would release more money on the line and allow me to break
Hmm.
ground on more, so he's not exposed to too much and everything like that. I wanted to ask you, is there a finance advantage to doing it your way, where I mean, obviously your revenue's starting to come in, to units 1 through 10 while you're
Right.
building out, 21 through 30 down the road. Are you able to revolve debt through units and roll things to perm as you go? Or is it all one big finance package? You don't roll to a perm until it's all finished?
Yeah, the ladders. We can't that structure you described where you kind of have each unit has kind of its own mortgage on it basically
Oh, okay.
is very capital efficient, right? I mean, that's how a lot of the built to rents, kind of option one and option two that I mentioned earlier.
Yeah.
That's how they finance theirs, which is kind of equity light because you can keep rolling that equity in the next home, next home. That's not how we do it. We get a loan on the whole thing,
Yeah.
right? And
And
we're
that first,
not
the
able to
first, the
take,
first strategy, that's how like the big dogs like DR
yeah,
Horton, I don't know if that's who you work for when you were doing the build
yeah,
world, but like those guys, that's how they're structured, isn't it? Where
correct. That's correct.
that's how they're able to build all across the country, is okay, I'll just build and I'll just roll through my
Yeah,
line of credit or whatever I have with my lender, and I can just recycle my equity over and over and over again.
right.
But you're not able to
Yeah,
do that because of the way that you're parceling out the land, right?
right.
Okay.
Yeah, because we don't have any individual lots. There's no way because you're usually shifting that from one facility to another facility, right? You've got a construction facility that's your line of credit, then you're converting it to a mortgage facility
Yeah.
on a finished project,
Yeah.
dropping your interest rate until you sell it, and then obviously then it goes on to somebody else. We can't do that because we don't have individual lots, so we have to finish the whole project, get it stabilized, and then we put permanent financing on
Okay.
it. Which is why but it is in a way it is very capital efficient for our lenders because they love it. By the time we're making construction draws, because we're delivering these units,
Yeah.
in packs of 30, we're already leasing. We're already
Yeah.
cash flow.
Hey, you got money
We're not
coming
cash flow
in.
positive, but we're
Right.
revenue positive, right?
Yeah.
And we're proving out the rents that we showed in our underwriting. So our lenders love it. They just, we've got probably 4 lenders. We've done $1 billion with each one of them. They're like, this is super simple.
Yeah. Well, I mean, I would
I'm a
think,
simple guy.
well, that seems to be like the equation of success. You figure out a simple solution, and
I,
then just rinse and repeat and do it over and 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 over again, right? Like
yeah,
McDonald's
yeah, yeah.
101, right?
Yeah, I am the boringest guy you've ever met, probably in terms of business strategy, but it works.
Yeah.
And you don't make mistakes, right? We've delivered over 11,000 homes under
Mhm.
this strategy. And they're all the same 1, 2, and 3 bedroom floor plans, right?
Yeah.
And so some people would say that's kind of boring, but I
Yeah.
don't know. I think
I hope you
it's
like
fun
it.
to build a, yeah, it's working out for me.
Yeah. Did you
So
hear that Henry Ford quote? Like, you can have my cars any color you want as long as your favorite color is black. Right? Yeah, that's it. I'm not going to give you color, just black car. That's it. Model T. Going back to the one last comment on the way that you're structuring your debt, that as you're leasing out, you've got rents coming in. I would think that the lender likes that too, because like you see, you got revenue coming in. You probably don't need as much interest reserve in your
right.
capital stack as you would if you were going to build the whole shoot and match out all at once and then do a big leasing campaign. And as well, you can just kind of, maybe if the leasing campaign's not working, you could try something a little different. Oh, let's try some paid
Yeah.
Facebook ads. Let's try this. Let's try that.
Right.
Try different color
Right.
balloons.
Exactly.
I don't know. It's something to get people out here, right?
The wavy balloon guy,
The
right?
wavy balloon guy. Everybody loves the wavy balloon
Yeah,
guy, right?
that's my favorite. That's my favorite. Yeah, I mean, they love that they see their revenue coming in. We can make adjustments. Also, by the time we finish the last unit, because we're able to move people in as we go along, we're like 60% leased when we deliver our final home, right? So
Yeah.
we're a lot further along than if you deliver 150 units in one big building,
Yeah.
right? And now you start leasing. Well, you got a long time before you start
Sure.
actually getting traction on it. So
Yeah.
we pre-lease. So even before we're moving people in, we're leasing. So it's just a way more capital efficient structure.
Is it your PM company that are you vertically integrated? And if so, how long have you been that way? Or are you using third party management to lease up and manage your properties?
We're a lean organization. So we use third party property management,
Okay.
but I have an asset operations team that oversees them.
Mm-hmm.
And they are all over it. And similarly with construction, we use third-party general contractors, but we have a national construction team that oversees them. The guy who runs it was a general contractor, president of a general contracting company. So like we trust but verify. That's something we talk about a lot. It's like, listen, we don't want to have all these employees, but we're not just going to hand it to the general contractor or to the property management company and say like, do our, we know you're going to do this great. Like we keep our eyes on them. So we kind of have the best of both worlds, I think, in that we get great pricing. And also we are truly partnership oriented. I know a lot of people say that, but like we've had the same general contractor in Dallas since we started, right? And we've done, I don't know, 16 projects with them. And we sometimes bring in new general contractors as we kind of get,
they've never pissed you off yet. That whole
thing,
yeah,
it's always been great. Never had
amazing.
An issue ever.
Hey, yeah, that's contractors' relationships. It's always great, right?
But I've been around long enough that I know that you get a general contractor, it's all great in the beginning, then you hate each other, you get into a fight, you break up, now you don't use them anymore, you get a new general contractor, you love them for the first year, the next year you hate them. It's just like, just work with the general contractor you have, right? Like, what are they doing that we aren't happy with, and communicate that to the owner and say like, listen, let's try and figure this out. And the same thing with our property management partners. I mean, it hasn't been all, puppy dogs and flowers, but I mean, when they're not doing well, communicate with them. And sometimes it's our problem, right? Sometimes we're doing the wrong thing. Sometimes we're giving them bad direction or micromanaging or whatever.
Josh, you've been able to maintain relationships long-term with contractors. I've made this joke that in the world, there are human beings and then there are contractors. Because I'm the guy that's been burned by a lot of them and everything like that. And this is probably, because I've done a lot of C-class renovations, and the contractors that are doing C-class stuff, they're their own breed too. And it's like,
oh yeah,
you'll take a guy that shows up on time and sober, and all that. Like, okay, good. But we just built a 30-unit apartment building in Trenton, and that was a whole different grade of contractors. And I would work with those guys again. They did a great job. They were certainly more expensive per square foot than than two guys in a truck kind of thing.
Right.
But you get a more sophisticated relationship in that. So I wanted to ask you a question about construction and property management. At some point, you looked at the jug of Kool-Aid sitting in the back of the room and said, I could go vertically integrated. Why are those PM companies getting all those fees? I could get those fees. I could control my destiny a little bit more, right? And you either tried it and it didn't work, or you said, you know what? I just never did what. But for some reason, you chose not to own your own PM company and own your own construction company. And I know you thought of it, but you didn't do it. Why not?
Yeah. So first of all, PM companies don't make that much money, so that's one reason not to do it. But I mean, so here's how I kind of think of things. We were super happy with one of our partners, property management partners, with how they treated our residents, how they managed the properties, all those kind of good things. We hated their financials, and we didn't like that we had multiple different property managers with multiple different financials. So we took all the accounting, all the IT, and we have our own license of the Yardi system, which is basically how you manage your residents. We own that, right? So we took the part that we weren't happy with, and we took it in-house, and we now can do it. We can roll up all of our properties. We've got 64 properties. We can roll them all up, ourselves, and we're happy with that. And we worked really hard with our property management partners to make sure that we had a training program to give our residents the best service in the world. But what I don't want is 200 employees that comes with having a property management company, right? I don't want that. And so we really took it seriously, working with them and partnering with them to do that. And then on the construction side, that's even funnier question, because when we started the company, so I was the only employee of NEXmetro for 2 years when we started the company in 2012. I was doing everything, washing the dishes, doing the accounting, all like acquisitions. And when I brought in my now partner, my chief development officer, he has the same background as I do. So we both have about 30 years. He has a little bit more than me, probably 35 years in the business. And he's a construction guy, right? He knows how to build, he knows how to do site work, he knows how to do all those things. And I brought him in. And of course, the first natural thing, he's like, we need to just do this ourselves. Let's not use a general contractor. I said, just hold on, like run the program. I don't want to build this huge organization. And now he's drank the Kool-Aid. He's like, I don't ever want to have vertically integrated construction because we don't have to deal with all the BS that they have to deal with. I
Yeah.
mean, they make money, but they also deal with a lot of challenges, right?
Sure. Yeah. Yeah.
And so we just, could it happen someday? Could we have become vertically integrated on construction and on property management? Certainly. And I think we even have the skill set to do it today, but we're so focused on growth, and we make, our money on developing projects and, making another small fraction of income because we do our own general contracting. It's not worth it, right? I'd rather just have, and also as we started in Arizona, like we were a nobody. So then you go to Dallas, like good luck if you go to Dallas and you think you're going to be a general contractor and you don't have any reputation, right? Like you're going to get homeboyed like you've never been homeboyed in your life.
Yeah.
And so going into these new markets as we've grown and picking a general contractor that's like a mid-sized general contractor where we're important enough to them, right? Where they're going to give us attention, but they have a sub base and they know the market and they understand the construction and all those kind of things. That let us grow the way we have because we're in 7 markets now. We've been in business for 13, 14 years. And we're in 7 markets. We've delivered 11,000 homes, like all these things. We couldn't have done that if we just tried to do it organically. Just couldn't have. And so it's part of the growth strategy versus, in the future, as we continue to get bigger, at some point, maybe it does make sense to bring it in-house. And maybe that'll be for the next CEO of NEXmetro.
Well, yeah, no, it sounds like you've gotten pretty far without doing it, right? So at this point, hey, call me whatever you want. I'm not the smartest man in the world either, but hey, if it seems like it's working, right? So maybe you should keep doing it. But a lot of folks in our industry, not just in the BTR space, but in my world, in the multifamily space that I'm in, everybody seems to want to get vertically integrated. I want to control the whole stack. I want to own the PM company. There was a big movement to start PM companies, and because there's just not that many good PM companies out there, right? And so you did it out of necessity, out of quality control, like out of like I want to be able to have my finger on the pulse. That's why we did it. But it's a complete fucking pain in the ass. It is. It's not It is not something that you make a lot of money in unless you're managing 10,000 doors or more, right? And that, so it's not for the faint of heart. And there's good companies out there that do it well. So I'd rather just do a little bit more work and find a better PM company, than
I think it's, I that's kind of how I feel about it. And a lot of people, even in the institutional world, will ask us, why aren't you vertically integrated? Why aren't you doing your own property management? And then when I tell them why, they're like, yeah, you're right. You don't want to do that.
They don't know
it's, they think like, oh, you're going to have more control. And I always use the example of, I used to work for one of the biggest home builders in the country, and we were fully vertically integrated. And I was on the development side. I was civil engineer, so I'm doing all the site work on master plans. And then we had our construction team. We were butting heads all the time.
Sure.
I mean, it's not like everything was paradise because we were vertically integrated and I got along with the guys on the construction side. They were always complaining about us. We were complaining about them. So to me, it's all about managing that relationship, whether it's internal or external. You're going to have to deal with it. So I'd rather deal with it with an external partner. They can have other partners, right? If you're a general contractor, like if I'm a general contractor, internal, I got to keep that machine fed. I can't turn it off because I've got a bunch of people that I'm taking care of. If I'm using a third-party general contractor, they can be building multifamily, some office, this, that, the other thing. When I tell them
somewhere else,
it's like, hey man, I know I had 3 projects for you last year, but this year I only have 1. That's their thing to figure out.
Yeah, so you could like straight up decide that capital's a little light right now, or I got enough going on. I'm going to not break ground for another year. You could decide to take a year break. You want to go, tour around Europe or something like that, and not work for a while or whatever it is you choose to do. You don't have to keep a machine going. So there's a double-edged sword to going vertically integrated, I'm sure. So
helps you make better decisions, I think.
All right, best of listeners, we're going to take a quick break from our sponsors, and we'll be right back with Josh Hartmann, who's going to tell us all about how he's funding these type operations with equity, how he's picking locations, and what he does with these things when he's done with them. Once the paint's drying and they're all leased up, does he hold them forever or does he sell them? Let's find out after this word from our sponsors. Hey guys, we're back with Josh Hartmann from NEXmetro. No T in there, just NEXmetro. By the way, funny name. Why is there no T in NEXmetro? It's just at NEXmetro. Right.
So my partners at the time, I've got the 4 core partners that we started the company with. They are serial entrepreneurs. And at that time, every company they were doing was Nex something, NEX cab, NEX, whatever.
Yeah.
And it just happened to be NEXmetro. It's
It's just,
no specific magic to it.
yeah, no. Like you said, it's the best branding idea ever, right? And I'm sure people want to throw the T in there all the time. You're like, no, there's no T.
Every time I get every time somebody's like, I sent you an email, I'm like, I didn't get it. I'm like, did you put the T in? They're like, oh yeah. I'm like, that's
Yeah.
right. So,
You should go buy you should go buy the T domain, the NEXT Metro domain, right? Actually, I'm gonna go on GoDaddy and buy it and I'll flip it to you. Okay. Right.
Yeah. Perfect. Let me know how much.
There you go. Right. Yeah. No problem. But so your company's NEXmetro, right? But your product that you had said is called Avila, right? Why?
Correct.
How has that worked out? Like there's got to be a leverage play there for you in being able to brand the end game product that you're building with one brand and then the funding arm with a different brand. How has that played to your advantage?
Yeah. So like many things, when you're starting an entrepreneurial kind of new company, like not everything you do makes sense and not everything you do works out the way you thought it was going to work out. So the reason we had the brand originally was we thought we were going to have multiple different products. So NEXmetro was going to be the parent company. We were going to do all kinds of different housing products. Avila Homes just happened to be the first product we started with.
Right.
And we wanted to be able to kind of like segment that out, right? Like, hey, we're doing Avila Homes and we've got, I don't know, whatever, Hartmann Homes, wouldn't be Hartmann Homes, but you know what I'm saying? That was initially the plan. Also, we felt like we could create brand recognition if we have every single community be called Avila something, right? So all of our communities across the US, they're all called Avila, whatever, Avila Broadway, Avila, River Creek, whatever it is. And everyone thought we were crazy. They told us this is multifamily. Nobody cares about the brand. And this was before you had the broadstones and some of the ones that have come since then. And they were kind of right. I would say early on, it caused problems because our investors were confused, right? They're like, well, wait a minute. I want to invest in a villa. It's like, you're NEXmetro. Like, why? What's the difference? Why is it not called?
Yeah, I think I've got the wrong phone number. Yeah.
Yeah. Everyone's like, I'm sorry, I'm calling for a villa. It's like, no, we are a villa.
Yeah.
So initially it was not great because it just caused some confusion. And I even had some pretty substantial investors of ours say like, why don't you just change it? Just be a villa. But now we've proven out that our brand is we actually have brand recognition because we've gotten scale in the market. So we've got probably 5,000 units in Phoenix, right? And people know what a villa is. And we even have people move from like a villa in Phoenix and they're moving to Texas, to Dallas. And they're like, hey, I see you've got a villa in Dallas. Can I just, will you give me a break on my rent break? Or my lease break if I move to the one
over there,
in Dallas. And I'm like, yeah, no problem. Yeah, but obviously, so now we have brand recognition. People know what a villa is, and it's been helpful. And who knows? I mean, we may someday do another product line. I just think that it didn't happen as quickly as we thought it would, but it is what it is. So it's worked out fairly well. Not the way I planned it, but it is what
I can see at the end of the day, your consumer is different, right? The Avila consumer, who is that, right? Like that is the resident. That is the person that's going to hang their hat in this home, right? The NEXmetro client is the whoever the investor is, private equity firm, the individual,
right?
In that. So that's I think that maybe best ever listener, the lesson to take here is to question at all times who the avatar is that you're marketing to. Who is it that you're putting things in front of? Maybe it's okay to put the same brand on the whole thing, but if it's a completely different demographic that's doing business on each side of the transaction, maybe it's worth considering rebranding.
Yeah, that's true. And you might, yeah. I mean, if you look at our NEXmetro stuff, it's a little bit more, I would call it like masculine and kind of like, like NEXmetro, right? With colors and whatever. And our villa is a little softer. Hey, this is your home, right? So so you want to have a different impact with those two. And then with a villa, we actually built a townhome community in Atlanta, and we didn't name it a villa because we're like, we can't confuse the consumer when they walk into a villa. It's a 1, 2, or 3 bedroom, single story, detached with a backyard, leasing office, blah, 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 all the same. And we happened to build this townhome community. I won't get into why we did that, but we did. And we're like, it's not in a villa
That's smart though. It's
because
not in a
people,
villa. Yeah, because then you
yeah,
would get people that are that know the brand that you're trying to move there from somewhere else, or that like, oh no, that's not that. This isn't the product that I'm
yeah,
used to, right? So
yeah, yeah.
interesting.
Or you can't market it all together, right? You can't put on your thing a villa homes,
Yeah,
single story detached homes,
yeah.
because one of them is townhomes and they're attached.
So let's lean into the NEXmetro model a bit with regards to equity. Are you working with larger institutions, family offices, private equity, or are you working with a lot of is it retail investors, the air quote,
Yeah.
mom and pop retail model? How are you funding your deals?
So when we started NEXmetro, it was all past the hat, right? So
Yeah.
my partners and I, we'd raise equity, people who we knew over time that grew and grew and grew. So, now we have 250, probably 300 investors, but all high net worth family offices, small family offices, individuals writing personal checks. We have not taken any institutional capital at this point. We've had plenty of opportunities, but we really like knowing our investors.
Yeah.
We do work with RIAs, wealth managers. So,
Sure.
that is another channel, and we're on iCapital and those kind of things. But we like the retail. I hate calling them retail capital. We like the retail capital partners because we feel like they're more rational. And the reason we are still building right now when others aren't is because of that capital, right? We raised over 50 million last year. We're going to raise over 50 million. Probably raise closer to 100 million this year. So we've been able to keep on going because not every one of those investors. Some investors, for whatever reason, when the market's low, they want to sell, and when the market's high, they want to buy. So we have some of those investors who are like, "Oh, the market's terrible, I want to get out." But we have more investors who are like, "This is the time to get in," right? So we're raising great capital right now. All of our stuff goes in annual vintage funds. So we have two structures that we do. One is we call our direct access fund. This one is 2026 that we're currently raising, but that's for projects in 2026. We did one for 2025. We did one for 2024. So every year it's a vintage fund. But we encourage our investors, don't just invest in one vintage. If you're going to invest with us, plan on investing about the same amount every year into these vintage funds, because you never know what's going to happen with if you invested in 2021 right now, you're probably regretting it, right? So you want to avoid that situation. So that's one structure we have. It's just classic, your top of the stack equity investments, returns in the high teens. And we do it as a fund. So you're in multiple markets, multiple projects. So you have diversity of product, and diversity of market, and diversity of project. The other one that we created a few years ago at the request of our investors, and we're super data focused. So we're always serving our residents. We're serving our investors. What do you like? What don't you like? And some of our investors they're getting older. When they started investing with us, they were in their early 60s. Now they're in their mid to late 70s. They're like, hey, I don't know if I want to make another 5-year investment. I'd be willing to take a little bit lower return if you can give me cash flow. So we created our NEXmetro dividend fund, which pays a quarterly dividend, 10.5%, and we have a lot of investors who kind of put a little in both. They're like, hey, I like the dividend fund because I like getting checks every quarter, but I also like the bump of the direct access fund. And so that's the two structures that we have, and we've got them. And we've actually raised the same amount in both the two funds. We raised the identical amount of money in last year. So
that's great.
We certainly have investors who like both.
So what did the dividend fund pays? What you said, 10.5%, you said?
10.5. It's based on the 2-year. So I think it's a 6.5 spread on the 2-year based on the average of the prior 12 months. So it was 11 last year. Obviously the 2-year came down with everything that's going on with the treasury, and we're now at 10.5. It'll be 10.5 for the next year, and then we'll adjust again next January.
And do you treat that capital in your company as like a pref tranche that might sit between the common equity and the bank, kind of like a short-term, just short-term bridge, but just kind of like a tranche in between, right?
That's exactly right. Exactly right. That's what we play. We use it for that, and we use it for land loans, but mostly for pref, because we're going out and getting pref from institutions or these debt funds, and we're like, well, why are we paying them when we have investors who would like to get that, and we can actually make it more efficient because we're not paying a bunch of origination fees and all that kind of stuff. So that's why we formed it. We just it's an open-ended fund, so you can put it in. It's got a 2-year lockup, and then you can take it out quarterly, certain gating provisions.
Question. The best ever listeners, take note of this, right? First of all, we all want to be, run around with 11,000 units, something like that, like NEXmetro is. But as we grow and scale, best ever listeners, remember this, that an institution is going to roll in and want 15, 16%, maybe 8% current, right, Josh? Plus
Right,
another
right,
8% on the back end or something like that.
right.
But you could find a investor that will take that. If you don't have investors that'll take that kind of rate of return, find a capital raiser. There's so many folks in the best ever community that you can reach out to that could raise that capital to be a pref tranche for you. And it's going to be a lot
Yeah,
more friendly. It's not going to be like doing business with Tony Soprano, right, Josh, where they're going to want,
right,
they're
right.
doing this just so they can get their hooks into your deal and say you didn't
Yeah,
say Simon Says one day and come and take the property back from you or something like that. So I
right.
believe in offering those middle bridge opportunities to retail investors myself. So not that I don't love my
Yeah,
friends at Pref Equity, but guess what? They're not going to know that you and I are doing business with other people. They're
yeah.
not going to miss us. They got plenty of other
Listen,
opportunities. So
yeah.
yeah,
Listen, we're doing the same thing they're doing. They can't complain about it, and we
yeah,
and I think the retail investors have less opportunities to access that, right? So if you can
sure.
find a good sponsor that has a long track record, and you can feel comfortable that that's going to be consistent. It's kind of funny. One of my capital raising, capital formation guys, he's like, yeah, we should put on we've never missed a payment. I'm like, what? Like,
Yeah.
that's something we should break. I'm like, I would, I mean, I get it. I get why you'd say we never missed a payment, but like, people don't make payments. Like, what do you mean they've never made a
Yeah.
payment? Like, it's kind of a funny thing where it's like, you want to have somebody that's got a great track record because, I can't even imagine. Also, by the
Yeah.
way, my partners and I are all invested in that fund. So if we missed a payment, like, I'm
Yeah.
going to get a bunch
You
of phone
miss on
calls from
that
my
too.
partners saying
Yeah.
like, what the hell is going
You'll
on? I mean,
notice. Yeah.
we're like 12 to 15% of funds in all of our, like,
Mhm.
our direct access fund and our NDF. All my
Yeah.
partners are in it. And I'm the junior guy. Like, my partners are all,
Yeah.
you know, semi-retired and retired. In fact, one of them, he passed away, and his daughter is on our board of directors. But like, you want a business where the people who are putting the work in and managing your money are putting their money where their mouth is. So
Absolutely, absolutely. So, you mentioned that you're using some of that short-term bridge cash for site, for land and stuff like that. Are you acquiring? This is like a vertically integrated thing, right? Are you acquiring the land and then getting it shovel ready through the land entitlement process and the permits, and then doing the what they call like the site work, which best ever listeners, that means like the roads and the plumbing and all that fun stuff before you do what Josh is calling going vertical. That's truly going vertical, building physical structures above the ground. But as we all know, there's things that have to happen in the ground, right, Josh, before you go vertical, right?
yeah, yeah, right,
Is your
yeah, yeah.
company doing all that, or are you buying fully entitled, fully improved land that's ready for cranes and ready for shovels in the ground the day you close?
We are we are doing it all, but we will not close on a property until it's zoned for our product. So we get an option on a property,
Okay.
and as you can imagine, based on how I described the Avila product, it doesn't fit any zoning categories. So almost
Mhm.
every time we're doing a zoning case, some kind of variance, et cetera, that can take 12 to 36 months, depending on the jurisdiction.
Yeah, I bet.
That's all on us. We do that. That is not a risk to our investors. That's our risk. Once
So
it's
so
zoned and
saith
approved,
so saith the civil
yeah,
engineer, right?
yeah, 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 yeah.
Honestly, it's your
Exactly.
background in that world, right? That's what a civil does. I mean, they know and understand that world, so I get it why you would wanna control that
Yeah,
side of the equation, right? So,
yeah, yeah. So
yeah.
we get through all that. We de-risk the project for our investors because we don't want to take. Then we take the property down. Usually buy it. We buy the land, and then
Mhm.
we get all the rest of the finishing touches. As you probably know, Matt, it's, hey, yeah, you've got your zoning, but you still got to get your civil plans approved, your architecture
Oh,
approved.
yeah.
That's all just a process. There's no risk there that you're not going to get that approved. Then when the project's ready to start go vertical, that's when we bring our capital. So bring our capital investors in when the thing's ready to go. They're not taking any speculative risk on that the project will not go forward. And then we're building it, you know, from the ground up. We're never buying finished, even we're not even graded, right? It's just
Yeah.
we're buying it raw land
When when you
and then
first
building it
got
from scratch.
started, were how again, because the best ever listener here has got their wheels turning, I mean, I get that you've done this to a point where you've got, operating reserves, you've got coffers, your own cash, company line of credit, whatever it is you're using to do that, the early soft cost stuff. When you first got going, were you bringing in investors that had like a higher risk threshold to work with you on the land stuff and on the soft cost and all that? Was that your own startup cash? And also, what would you tell a best ever listener that wants to get into the BTR world but needs cash to do the paper development, the engineers, the architects, the lawyers, and all that to get the land shovel ready?
To answer your first question, I'm just fortunate that that my partners are well heeled and they wrote a check to fund the company for the first 2 years before I got the first shovel in the ground. That's just the truth. I guess that'd be my first piece of advice. Find somebody who can write you a $1 million check to help you defray those risks.
And
defray those costs to do
you,
yourself.
is willing to bankroll it. You probably had to give them a little bit better than a 10%, cash on cash return on their money. They're getting, they got real skin in, and they're taking material risks. So it all adds up, right?
Yeah, and they're owners, right? So that's my board of directors. They're the guys and gals that I meet with every quarter and tell them what's going on. But they're also the owners, and they're ones who put the money in to begin with. So that's how I did it. I guess I would put it that way. I didn't go find them; they found me. I think if somebody wanted to get into BTR today, I would probably say if you want to develop, I would buy a platted lot, right? And I would not do a product like, unless you can find someone to sponsor. If you don't have the money yourself, obviously. I don't. I grew up, middle class. If you can't find somebody who's going to help bankroll you to get started on your first projects and go through zoning and all that kind of stuff, take that kind of risk. It's much easier to do like a townhome community, right?
Yeah.
Where you could go buy a piece of dirt that's zoned for multifamily, could have a plat on it already, and then you just hire a general contractor to build it for you, right? You're probably not going to make as big of returns, but if you don't have to bring in a bunch of partners, you're splitting the pie up less, right? And so you can control your own fate. And the other thing that I think is, like, you want to take as little cash as you can for as long as you can, because that allows you to build up. Like, so say you find one project, you raise the capital yourself, you do a little syndication, you bring in the capital. That's a separate from your entity. You build that project, maybe you build another project. Now you have real enterprise value. Now you bring in a partner and they're buying in at a whatever $20 million valuation instead of a $5 million valuation. So you get less diluted as the owner, but you can use that capital to help you grow. It's just like a classic startup, A round, B round, C round, right? So that's what I've learned, is you want to kind of avoid bringing in more capital. A lot of people, like, they get excited and they want to bring in a bunch of capital, and that makes them feel like, okay, I've got all this capital, I can go do something. But that whole time you're getting diluted as an owner. I think go slower, but be able to control your own fate by not bringing in a bunch of capital and becoming, a minority owner in your own company.
Yeah, that's good advice. Don't one deal. Buy a platted lot that you could buy and put the shovel in the ground. Buy it on a Tuesday, and you're digging holes in the ground on Wednesday.
Yeah, and do it now while valuations are down 25% and construction costs are declining and interest rates are going down. It's like now's the time, because you're going to see a pop in value. I mean, that's the interesting thing in the market is every real estate economist I talk to, and as you and I were talking before the show, like, I talked to a lot of them. Everyone feels like there's going to be a pop in value here in the next couple of years, but no one can put their finger on how it's going to happen. So you say, hey, what kind of rent growth do you think we're going to have, and what kind of cap rates? And like, oh yeah, rent's going to grow 3% per year and cap rates are going to come to 5%. And I'm like, that's not a pop. That's an average market, right? That's not a pop. So rents are going to either have to grow more or cap rates are going to have to come down more. And I look at 2000, take 2009, 10, 11, 12. That's my, like, kind of corollary to today. In 2009, everyone was saying it's going to be a slow slog out of here. It's rough. The markets are terrible. Rents aren't going to grow, blah, blah, blah. What happened? 2010, 2011, rents grew 3.5%, 4%. Cap rates compressed 150 basis points. Values went up over 50% in 3 years. That's a pop, right? To me, that's a pop.
Well, do you think there's going to be a pop? I get the economists, the folks that are smarter than you and I, that are just sitting in a cubicle, crunching Excel right now. They think that, and those that I talk to all say that too. And they're just saying that because they think that, these awful terms like, oh, we're due for it, right? Well, I get it.
Yeah.
Go play roulette if you think we're due for something, right? Why do you think that there will be a pop in, like, A-class housing prices? Let's call what you're doing A-class, newer construction housing prices.
Newer construction, yeah.
Do you think there will be a pop in that housing product, and if so, why?
I absolutely think there will.
Okay. Especially
in our markets. So we're kind of Sunbelt markets. I described them earlier, right? So that's where you had oversupply. That's what drove down rents and drove down values. That oversupply is past or near past, depending on who you talk to. And so Now that the supply the glut of supply has passed us, now we're in an undersupply situation. Values of, so like take Austin, for example, starts are down 70%. Well, you know this, Matt, you can't build a new project in 12 months. Like, right. If I put a shovel in the ground today, I'm delivering 2 years from now. So you're going to have minimum 2 years of undersupplied housing in a market that already had a problem with housing. Right.
Yeah. And that's because everyone's not using modular construction, Josh, you see.
Exactly.
If the modular guys, if we would just freaking listen to those guys, you'd be able to build a lot faster.
Yeah,
but for some reason or another, nobody's building modular. So it is taking 1 to 2 years, right? But if the modular guys have their way, we can just wave our magic wand and build 1,000 units in housing overnight, right? Well, okay. Sorry, guys, can't do that.
Who's sponsoring this podcast?
I just have, right.
Tim's Modular.
Yeah. Clayton Holmes.
So Clayton Holmes. There you go.
Yeah,
but I think that
Warren Buffett, right?
Warren Buffett. So,
yeah.
But I think the simple answer to your question is this. And again, this is the same thing that happened in 2009. There's all this cash on the sidelines that wants to deploy, that hasn't been able to deploy for several years in the multifamily space, right? Mm-hmm. And those guys get paid to allocate, right? Yeah. They don't get paid if they don't allocate capital. So they're starving for a bonus. And as soon as you start to see rents growing, you're going to see them all start to rush back in and compete because they're going to like, oh shit, it's FOMO.
Yeah.
I'm going to miss out, right? I got to start buying. Values are going to start going up quickly. And that's where you got that 150 basis point, decline in 2010, 2011.
I think that what you're saying is that there's a lot of, and I kind of hate this term, but I just say it just because it's fun to say. There's all this dry powder on the side. Dry powder what? Like you're gonna blow something up. Dry powder, really? But it's just a lot of money waiting for things to settle down, right? And when I was just at Best EverCon, we had a panel of retail investors and a bunch of institutional guys too, and they all were like, "Yeah, the institutional guys are waiting," and the retail guys were like, "Yeah, the retail people are from the data they've seen is that the average retail investor has money they'd like to put back to work into alternatives, dare I say what we do with alternative space, that there is money looking for a home and they're just kind of waiting on the right timing. And so I think that you're right, is that there'll become a lot more demand for investment grade stuff that like you're producing, and that is going to be what drives cap rates down by probably 100 basis points. We also need the interest rates to creep down a little bit more, and they are. Nothing happens overnight in the interest world, except for rates going up as fast as they did, but that's not going to happen on the other side, right? Yeah, it's not going to retract as fast as it went up.
Yeah, and the institutional guys, they get a bad rap. It's like, oh, why aren't they investing? Well, the institution, they really don't get any extra credit for investing early, right?
No.
Like they have a certain hurdle they got to hit, and they get in a lot more trouble if they don't hit that hurdle than if they far exceed that hurdle. Right? You don't get a lot of credit for it. So they're just waiting. Until it's a no-brainer. Like I get it.
Wait. And when the maths out that they can get in, they will get in. And then it's just it's a simple, red light, green light, and the light's still red right now.
You just got to get in.
Yeah.
You got to get in front of them, right? You got to get in enough in front of them, but not too far.
Yeah.
So that when they come back in, you've got assets, right?
Yeah.
Now you get to benefit from kind of their delay.
All right, so with your product, it doesn't sound like you are, because you guys are still sitting on like 11,000 units and all that. It doesn't say, some of the folks that I've talked to in the BTR world, because the economists and the tea leaves of the world seem to think that America is going to become more and more of a renter nation, especially in areas where there's a lot of jobs and stuff like that, like the Sun Belt where you are. So because of all that, because of the people, the desk jockeys that are running Excel spreadsheets right now, all those guys are advising big organizations like BlackRock and Goldman Sachs and all the other private equity firms and whatnot to own BTR housing long term, because that is a stable bet that America is going to become more of a renter nation, especially places to raise their kids, or like you said, the barbells and all that. Are you selling to private equity, or are you just holding it for cash flow? What is your exit? Because I've heard that private equity loves the kind of stuff you guys do. But if you guys are sitting on 11,000 units, maybe the data says that you're not selling. And if that's the case, why?
Yeah, so I should clarify. We've built 11,000 units, but our portfolio currently is about 7,500. So we've sold about 4,000 units.
All
so
right,
we do sell.
My bad. My bad for asking.
No.
Okay.
It's all good. So we had to sell especially early on, because we had to prove out the product, right? So what kind of cap rate is this? Because nobody's seen it before.
Right.
So we've sold to private equity. We've sold to large family offices. We've sold to REITs. And again, as I mentioned, they just look at us as multifamily. We're just part of their multifamily portfolio. But it's easier. We are BTR, so they can kind of do the best of both worlds. They can say, hey, we just bought this BTR product. Everyone's trying to get BTR product.
Yeah.
But from their standpoint, from a financials, it's just multifamily. So they don't have to like learn anything new or do anything different. And so I do think that demand is going to keep creeping up. And then you have to look at catalysts, right? So there's a legislation going through the Senate right now that is trying to discourage institutional ownership of single family homes. Which I don't want to get into the politics of that. Like, that's not my business. But there's a specific carve out for BTR. Why? Because we're adding to the housing stock, right? We're not taking away.
Yeah, they can't apply that to the BT to
right.
you know.
So it doesn't.
Right.
Yeah. So as an investor,
yeah,
right. As an investor, you've got these big REITs that need to grow, right? And maybe they can't buy single family homes as much off the MLS or whatever as they could before. So now they're going to try and do BTR.
Sure.
Well, what if you've got a bunch of BTR, or what if so we have this portfolio of 7,000 units that we could talk with a group and say, hey, we can help you grow your business by selling you this portfolio or partnering with us or whatever. So I think it's an opportunity for investors, right? I always think of those things like, I mean, it's like Sam Zell, right? He's always looking for the catalyst, like what's going to drive outsized value growth. I think this kind of legislation that's going through could be that. I think it's a good investment anyways. I mean, never make an investment based on legislation, but I do think we could see a catalyst in the BTR space as like buying single family homes becomes less of an option for these institutional groups, even though they are a small part of the market. Like I don't like, they're such a small piece of the housing stock that I don't think it's going to make that big of a difference on housing values, et cetera. But to those companies, this is an existential threat, and they got to figure out how to cover it.
It's interesting. So we've unpacked a lot here. Unpacked a lot of the strategy, that kind of thing. Give me a little bit more of a prediction for where you think, give me like pull out your crystal ball, so to speak. Where do you think things are going over the next, say, 2-3 years? Give me like the rates, the affinity for real estate and everything like that. Your continued consistency of, you're putting shovels in the ground and building and that. So maybe you are bullish longer term in the industry, but give me some things that you think are going to happen in our real estate investing world over the next couple of years.
Yeah, my crystal ball is a little fuzzy, but I'll do my best.
Yeah, mine's in the shop. Mine's in the shop. That's why I asked you. Yeah, right.
I mean, I think so. My prediction is, we had peak asset value in probably late 2021, early 2022, right? That was kind of when we saw the peak. If you look at least, it's certainly in the Sunbelt markets. I only know my markets. I'm not smart enough to know the whole country. But in the Sunbelt markets, peak in 2021, 22, 2020, I think we'll be back above the peak by 2028 asset values.
Wow.
Because I think you're going to see a rebound in rental growth. And I appreciate, by the way, that you're asking where we're going to be in 3-ish years. Because if you ask me where we're going to be next year, I have no idea, but I feel comfortable. In 3 years, something's going to happen. I don't know what it is, but I don't know when. I know it's going to happen in the next 3 years because I know we're going to have a super shortage.
Well, everybody
got shortage of housing.
Predictions, right? Do you remember the survive till 2025 thing? Yeah.
Oh, yeah.
It's like, well, shit, man, rates are still like, maybe it's 2035. We have to survive till, I don't know. But like people don't seem to be very good at predicting the next like 6 months of real estate and rates and everything like that. But longer term, things do move over time, So you think that we'll be back above the peak by 2028 with regards to pricing and everything like that?
That's my bold, unverified, and unresearched opinion.
Yeah.
But that's what I think that's what is going to happen. By the way, I'm a fan of history, and I think we all know history repeats itself in real estate, especially. So where the survive till 25, where that came from?
No, tell me.
Sam Zell, 1990, during the RFC, the crisis, that what he said, we need to survive to 95. People picked that back up and said, "Oh, survive to 25." Like I don't know if it came directly from that, but it's so funny that they were saying that back in 1990, and now they're saying it in 1992. Yeah, and now they're saying it again in 2025. But yeah, it's like just because it rhymes doesn't mean it's true. Yeah, as we found out,
cool
right?
Thing. And Sam was probably right to give everybody 5 years. The guy that I heard say survive till 2025, he gave it like he said it in 2023.
Last year.
He's just crossing his fingers and hoping like, please, that's all I can afford to do is survive till 2025. So I hope I'm right.
He's trying to convince himself. Yeah, he's trying to convince himself more than anybody else.
Self mantra. He wrote that on his wall in his bedroom. Like that's all I have to do.
And 25 came and went, and he was like, "Yeah, I was wrong."
Sam Zell, man, you brought him up a few times, man. I he passed about a year ago, didn't he? You know, and that,
He
but
did.
he was like an absolute, you know, juggernaut in our industry. They called him you know, in a good way, the grave dancer, because they would dance on the souls, or dance on the graves of his competitors
Yeah.
and stuff like that. I mean,
Yeah.
you know, he would go out there and buy properties, turn them around. He's very good at what he did. You know, yeah,
He'd be out buying right now. Like, I mean,
he
I really
would, he
admire
would,
people
yes,
like him who have no fear of being contrarian, right? I mean, in fact, he loved it
yeah,
because, you know, in a time like now when, I mean, we could be sitting in the best time for investment in the last 20 years right now,
yeah, he would know,
but everyone's afraid to pull the trigger, right? And he would just do it because he's like, well, worst case scenario, I make a good return. Best case scenario, I'll blow the doors off, right? And
yeah,
it's the same thing with Warren Buffett. I mean, you can go down the list. All these really great investors, they have an opinion, right? They're very smart, and they don't do what the crowd does. Because when
yeah,
you do what the crowd does, you get the returns that the crowd get. And
yeah,
what does the crowd get? 8%, 10%. Meh.
yeah,
You know, it's
yeah,
like I
yeah.
want outsized returns.
No, absolutely. And there's this good pragmatic mindsets to those guys too. I think that a lot of
Hmm.
things, like honestly, if you do a deal that makes good fiscal sense today, if you need the wind to change for your deal to make money, then you got the wrong deal. But if your deal makes
Right.
money today, like I was investing in 2010, and I mean, yeah, the deals that I bought didn't do too well with regards to property value, but they are pretty, you know, they cash flowed. And
Appreciate
so
it.
if you
Yeah.
get a deal that's making money that can cash flow, you know, in the current market, I think you're going to do better long term, you know, because eventually
Yeah.
things are going to go up, right? So, and if you can hold your breath for a
Right.
little bit, if you got fixed rate debt and I'm sure Sam probably didn't do too much floating rate, that awful weapon of mass destruction that's out there right now. So
Probably not.
anyway,
No, probably not.
well, Josh, it's been a great talking to you today, and thanks for joining this Best
Yeah.
Ever
Same, man.
CRE show. For those that want to hear more about NEXmetro or what to move to an Avila home, how do they reach out to you?
My email is super simple. It's just Josh, Josh, at nexmetro.com. Remember, there's no T in
That's
NextMetro
right.
after the X. So NEXmetro.com.
Josh at nextmetro.com. Guys, reach out, pick brains, hear more about what NEXtmetro has to offer. Josh, thank you for joining me today on the Best Ever
Thanks, Matt.
CRE
It's been a
show.
pleasure. Yeah, thank you so much. Been great being here.
Wow, guys, great conversation with Josh Hartmann from NEXtmetro. I learned about a few different things. I love what he talked about not having to go into all the different facets of the business, meaning like not intentionally not starting a property management company, not owning the construction side of the business, allowing third-party vendors to be there, allow them to maybe operate with a smaller team, because maybe you can run a business that you need and make the revenue you need and create a good lifestyle for yourself and all the things without having a couple hundred person team behind you, right? There's been a mindset in our industry in commercial for a while now of everybody's got to go to vertically integrated. You got to own the PM company. You got to own the construction company. You got to own as much as you can so that you can be successful, so you can own those different revenue streams, and so that you can control all of them, right? Well, Josh gave a good alternative to that, and I really appreciate that perspective. It got my wheels turning too. Hope it got your wheels turning as well for maybe BTR, and he gave some accessible ideas for those that want to get started in the BTR space. Hope you guys enjoyed all that as well. Do me a personal favor and subscribe to this program, okay? On your favorite podcast mantra. That's Spotify, Apple, whatever else you're listening to podcasts on. Make sure you subscribe to the Best Ever CRE show. I would appreciate that. And also, I'm going to share this episode with a few friends of mine that are in the construction world, because I'd think that they should hear more about the BTR space as something that they could either graduate into or investigate on their own. So I'm going to share this episode. I hope you guys do too. Thank you guys for being here with me today on the Best Ever CRE show. And until I see you again, have a best ever day.